So we can definitely begin. In today's topic of compliance officer training, loan officer training, I'm going to kind of give a lot of the new people kind of the beginning to Z of dealing with funding through the DTC and DTCC. Now, this actually will be labeled in the archives as Part 5, but I'm going to take time in Part 5 to go back through the fundamentals of funding and dealing with funding through DTC, DTCC. And again, for those of you that will have questions, please bring your notes. Please bring your questions. I ask that you press 9-4 on your keypad. That way, that'll allow me to cue you directly in. You'll be able to ask your questions where I can hear it audibly. Maybe I'll get at the end of this particular course where I just have like a group discussion, kind of like everybody kind of just ask questions. But if you have direct questions, I'll give you a chance to definitely ask those questions. But you use your keypad and press 9-4. That'll raise your hand. That'll give me a chance to bring you directly in, and you can ask your questions at that point. But so much to do, so little time. These are exciting times to be alive. I appreciate everyone who is participating in trustee training. Dealing with compliance officers abroad. You got to understand that 99% of your interactions with clients, customers, potential clients, and or customers are going to be dealing with the ability to recognize Article 9 security interests and being able to record those interests in an aspect of an accounting action. But understanding accounting, you're going to really have to look at the fact that accounting is based in two spheres. One sphere is accounting concepts, and then the other is dealing with accounting conventions. Concepts and conventions. I'm going to actually share my screen in this particular course, and for those of you that don't already have your accounting manual that I'm going to be going over, just make the request inside of Bitrix, especially for the new students. You might have hadn't gotten that manual yet. If you haven't, just make that request. I will provide that for you because you're going to need this. And I always tell new students to at least read the first 20 pages of this manual. When you receive this manual, you need to read the first 20 pages. I don't mean just read it once and put it down. Usually you're going to have to read something about 7 times to have any adequate type of retention. So I'm going to say read the first 20 pages at least 7 times before you can really kind of fundamentally wrap your brain around it. But I'm going to go to this manual for simplicity purposes and to explain how one should be dealing with funding through the DTC and DTCC. So here we go. Let me go ahead and bring up my screen here. All right, we're finna share the screen. Queuing it up here. It should be, the accounting manual should be on the screen. You guys should be seeing my accounting manual on the screen, which should be saying accounting concepts and conventions. You should be seeing that on the screen if you went through the link where you can see what I'm sharing. It starts out by saying financial statements are to be prepared in accordance with generally accepted accounting principles. This is because if each organization was to adopt its own principles in the maintenance of accounting records and publishing of accounting information, it will lend to a wealth of confusion. Such financial statements will have low acceptability as it will be difficult to understand them without first knowing the principle underlying the preparation of such statements. Also, financial statements prepared without generally accepted accounting principles at their base would be unsuitable for inter-period and inter-firm comparisons. It is for this reason that when accounts are audited by auditors, they see to it that the financial statements are prepared in accordance with generally accepted accounting principles, and they are also certified that the statements have been prepared in accordance with generally accepted accounting principles. I am going to highlight this section because for you guys who are new compliance officers, if you understand that financial statements have to be prepared in accordance with generally accepted accounting principles, and they also certify that the statements have been prepared in accordance with generally accepted accounting principles. You know, having this as part of your why, having this added as part of your verbiage, having this as part of your questioning when you're questioning certain transactions places everything in its proper perspective. For example, when someone provides you a UCC, you ask, is this prepared in accordance with the generally accepted accounting principles? And do it also certify that the statements have been prepared in accordance? So in other words, I'm looking at these financial statements to see if they are in alignment with GAAP, and that information that's being used in accordance with GAAP also fall into compliance with Uniform Commercial Code. So again, you can make this your mantra, if you will, your foundating statement. We used to call it accounting statement. You can make this your accounting statement when you attach it to financial statements. Let's go a little deeper into this. Talk about the nature and meaning of the accounting principle. There is ample confusion and controversy as to the meaning and nature of accounting principles. There is a school of thought which believes that the term principle connotes, keyword connote, fundamental belief or a general truth. As such, as it is incorrect to use this term with reference to accounting, because accounting merely as an art is only an adoption for the attainment of some useful, beneficial result. Adaptation inherently implies the changing nature and hence a sharp contradiction to the meaning of the term principle, which stands for fundamental truth. There is another school of thought which feels that the term principle means only rule of action or conduct, and such can be very correctly used in reference to the rules used in accounting. The American Institute of Certified Public Accountants, AICPA, has also supported the use of the word principle in the sense that it means the rule of action. It has defined the principle as a general law or rule adopted or professed as a guide to action, a settled ground or basis of conduct or practice. Plato and Liddington, in order to avoid the confusion as to the meaning of the term principle, has purposely used a new term, which is the word standards, in place of principle. Principles would generally, and we make sure we're clear, principles would suggest a universality and a degree of preeminence, which cannot exist in the human service institution such as accounting. Here are the essential features of an accounting principle. Accounting principles are acceptable when they, in generally, satisfy the generally three basic norms. So accounting principles must cover these three basic norms. A, usefulness. B, objectivity. I'm getting tongue-tied. Objectivity. The objectivity and feasibility. So it has to be usefulness, objectivity, and feasibility. In other words, it has to be useful, it has to be objective, and it has to be feasible. Accounting principles suggest the first basic feature of usefulness. As much as because of these, the accounting records becomes more meaningful and useful to the reader. In other words, an accounting rule which does not increase the utility of records to its readers is not accepted as an accounting principle. This is why you always hear us talk about accounting principles such as current expected credit loss provisions, because it does allow the reader to induce accounting rules and records which support the actual functionality of the provision. Accounting principles is that which is objective in nature. It is said to be objective when it is solidly supported by fact. It is objective when it cannot be influenced by personal bias and whims. Accounting principles should be such as are practicable. It will be seen that assets in an account are recorded at cost less depreciation as against at market price. This accounting principle is practicable and feasible because it does not entail the difficult work of ascertaining the market price of that asset. It does not make it obligatory for the accountant to record all the fluctuations in price of that asset. Let's talk about the kinds of accounting principles. To discuss accounting principles from the sense in which the term principles is used in the physical science, various other terms like postulates, concepts, conventions, doctrines, tenets, and maxims, assumptions, etc., have been used by the writer of accounting theory. Instead of wasting our time to discuss the precise meaning of these generic terms, we should concern ourselves with significant and the importance of these ideas in the practical work of accountants. However, a slight distinction is made between the two terms, concepts and conventions. The term concept is used to connote, look at that word connote, connotative, is to connote the accounting postulates, i.e., necessary assumptions and ideas which are fundamental to accounting, to the fundamentals to the accounting practice. The term convention is used to signify customs and traditions as a guide to the preparations of the accounting statements. To kind of help you out, I want you to associate accounting concepts as you hear my mentor Yusuf talk about the public and private. Associate accounting concepts with public accounting. And then associate accounting conventions as private accounting. Do this right now. Write your notes, when you get your manual, if you already don't have it. Associate those words in that capacity. It'll make understanding how these things all intersect and tie together easier to follow. Let's talk about the following important generally accepted accounting concepts. Concepts meaning public. GAAP deals with public entities. Okay, so we got what we call important concepts. They give us a list of about 11 concepts, and there are more than 11. These are just the ones that they consider as important. The number one, we'll just go from 1 to the 11. Number 1, they have entity concept. Number 2, they have going concern concept. Number 3, money management. Number 4, cost. Number 5, account period. Number 6, dual aspect concept. Number 7, the matching concept. Number 8, the realization concept. Number 9, the balance sheet equation concept. Number 10, verification and objective evidence concept. And then 11, the accrual concept. And you might have heard of the accrual more than most of these if you're looking at this at the first time. And there's a reason why you're probably familiar with that. Remember, these are the public accounting principles. Now, let's talk about it from precept to precept. Let's start out by talking about the entity concept. I call it the equity concept, but it's really the entity concept that they're going to be listing. It is very important to note that for accounting purposes, the business is treated as a unit or an entity apart from its owners, its creditors, and others. In other words, the proprietor of an enterprise is also considered to be separate and distinct from the business which he controls. All the transactions of the business are recorded in books of business, though they belong to the proprietor. From the point of view of the business as an entity, and even the proprietor is treated as a creditor to the extent of his capital. Capital is thus a liability like other liabilities, although the amount is owing only to the proprietor. The case of the sole trading and partnership concepts, the proprietors may even draw the amounts down or draw them out, thus reducing the liability of the business. But in the case of corporate bodies, shareholders stand on different footing. They cannot reclaim the amount they have invested. They can sell the shares to others if they desire to unload their investment. Therefore, in the case of corporate bodies, capital is paid out only at the time of winding up, provided surplus assets are available after paying off the creditors. In the case of companies, the entity concept is more apparent as in the eyes of the law, and it has separate legal entity independent of persons who contribute to its capital. Here's the money shot. The concept of accounting entity for every business demands a scope of what it is to be recorded and what is to be excluded from its books of business. So when you're exercising the entity concept, one of the benefits is that this concept of accounting allows the business owners to determine the scope of what is to be recorded and what is to be excluded from the books of business. Therefore, when a business receives cash from the proprietor's cash account, it is debited as business receives cash, and capital accounts is credited. Capital accounts representing the personal account of a proprietor. In the case of a corporate body, since there are too many contributors, the amount is shown under a single account, which is called shared capital accounts. So, in other words, they get to put it all together in this shared capacity. Guys, hold on for 1 second. Hold on for 1 second. Sorry about that. So another benefit is that all organizations, all businesses that are considered public entities, they have an ability to have multiple books of business. So there may be a book of business you'll have for the IRS, a multiple book of business you'll have for a shareholder, multiple book of business for lenders, creditors, etc. The beat goes on and the list goes on. So it is essential that you have appropriate books of businesses for various different Article 9 security interests. You have to understand these because, again, all what I'm just explaining is all on just one concept, and these concepts all govern what we call public entities. Listen to this. In case of a non-corporate body, there is no separate legal entity. Still, the principle of the business entity is observed for accounting purposes. For example, although for legal and most practical purposes, we regard the sole trader and his business as one and the same thing, we nevertheless, for accounting purposes, regard them as different entities. Therefore, in business, only the business assets and liabilities are recorded, although legally there is no distinction between his business assets and liabilities and his private assets and liabilities. Thus, the concepts of legal and business entities are not compatible with each other. This is also clear from the fact that in a case of big companies, each department may be the base for accounting, although the legal entity is much larger and covers all departments. Likewise, in case of consolidated statements, accounting entities is much larger than the legal entity. So when you got a large group, there'll be accounting that'll be done from department to department. And then in certain instances, it'll just be one level of accounting for the entire group or organization. Again, these things all fall up under the entity concept, or what I call the equity concept. Hopefully what I'm giving you kind of makes sense. Hopefully this is not what I'm going to go over you guys' heads. So before I go any further, I want to see if anybody got any questions over what I've covered up until this point. If you got any questions, comments, or concerns at this point from what I've covered, because I want to make sure you understand, please press 9 4 on your keypad. And when you press 9-4 on your keypad, I will be able to see your hand being raised, and I'll be able to ask, questions from that standpoint. But I want to make sure you understand that the entity concept is one that many businesses use to be able to show and record the relevant, useful, objective information pertaining to said transactions. See, it has to have those basic three norms in order for it to be proper. So again, checking to see if anybody got any questions, comments, or concerns. If so, please press 9-4 on your keypad so that I may, bring you on and have you ask your question. So I'm looking around, looking on my screen, seeing who's got any questions. Look like I don't see any questions. Nobody has pressed 9-4 on the keypad. So with that being said, we'll just keep on keeping on. Let's go to the going concern concept. This concept assumes that the enterprise will continue to exist in a foreseen future. This is in contrast with another view that the enterprise will be liquidated. According to AS, accounting standards, ones relating to the disclosure of accounting policies, going concern concept is a fundamental accounting assumption underlining the preparations of financial statements. I'll be preparing a financial statement and giving you a going concern because we intend on not winding up the business, not liquidating the business, but the business to grow and to be fruitful, in that regard. The going concern has a distinction when you really get the gist of it. Now let's talk about it. Under this assumption, the enterprise is normally viewed as a going concern. That is, a continuing in operation for a foreseeable future. It is assumed that the enterprise has neither the intention nor the necessity of liquidation or a curtailing materially of the scale of its operation. This assumption implies the following. When you use the going concern concept, understand this assumption is what's in play. Assets will be valued on basis of going concern assumptions. In other words, accountants do not record values of goods and assets which will be fetched if a sale is forced. Certain assets which are specific to a particular enterprise may have a very low market value. However, the value of such machines to the business is very great because of its productivity, its product potential, its productive potential, and the contribution to profits. Despite of this, accountants prefer to record assets at historical cost rather than adopt a value and use approach, which is favored by economists. This is because historical cost approach satisfies the test of objectivity and verifiability. Assets are depreciated on a basis of expected life rather than on a basis of market value. This facilitates the allocation of the cost of the asset over an expected period of the life of the asset and dispenses with the periodic consideration of material value. This concept strengthens and supports the view that depreciation is a process of allocation and not valuation. Thus, the going concern concept is the basic to valuation of assets and the provision of depreciation thereof. Next, we talk about the money measure concept. The money measure concept underlines the fact that in accounting, every worthwhile recording event happens or transactions is recorded in terms of money. In other words, a fact or a happening which cannot be expressed in terms of money is not recorded in accounting books. For example, general health conditions of the chairman of the company, working conditions in which the workers has to work, sales policies pursued by the enterprise, quality of products introduced by the enterprise, etc., cannot be expressed in money terms and therefore are not recorded in the books. In the view of the above condition, this concept puts a serious handicap on the usefulness of accounting records for management decisions. In other words, and I want you to hear me clearly because your brain should be churning, especially for those of you that actually may know of someone that is a security licensed broker, real estate broker, or you, let's say you're paid by performance, like commission. Your brain should be turning. See, this concept has another serious limitation and is currently attracting the attention of accountants all over the world. As per this concept, a transaction is recorded at its money value on the date of occurrence, and the subsequent changes in the money value are conveniently ignored. Let me explain this. If you, and we're going to talk about this practically, we're going to say that money inside of the banking system, as civilians know it, meaning if it's in the bank, not in your hand. I mean, when I say in the bank, you haven't started using it in your day-to-day, paying the bills, putting fuel in the vehicle, buying grocery, a kid's lunchbox, etc. When it's inside of the Federal Reserve System, we're going to say that when it comes to money valuation, this is where the money has the most value. And we're going to say in that aspect of what you think, what I was thinking before I came into this asymmetric information, that money was in a format or a category that we're going to call M3. So when money is held, quote unquote, here in the United States in a M3 asset capacity, it has the most buying power. When it comes out the ATM machine, it has the least buying power. So at the top of the money creation proponent, when it's created in that environment in an M3 format, has the most buying power. When you and I as consumers receive it, has the less buying power. Thus, something happens to an M3 asset where by the time you get it, it's got to have some insurance attached to it. So understand this money measurement concept, how they're explaining it. This concept has limitations, serious handicaps on usefulness of accounting records for management decisions. See, if money has lost all of its buying power, in other words, I want you to write this down. There's a document that's in circulation called House Resolution 5404. So let this be your money measurement concept go to. You will read what has been provided to the public in the aspect of House Resolution 5404. Then you'll know exactly what you need to be reappreciating on your books. This is why when you look at the debt clock, and I'm going to show this to you in real time. So let's actually go to the United States debt clock. I'm going to go back into my magic screen, if you will, that screen where I'm sharing these docs. I'm going to stop the share. And I'm going to actually bring up the shared screen once again. And I am going to go to the entire screen. Yeah, I see. If you have a question, just bear with me. I'm going to bring you on. Just bear with me. I'm in the middle of explaining something now. Let's go to the debt clock. The United States debt clock. This is how you're testing the accounting principle, the going concern concept from a state and federal level. Okay. Now you're staring at the debt clock, right? Debt clock's going to come up, and we're just waiting for it to populate because it's being shared and it's a little camera shy because it doesn't want to cooperate with all the syntax proponents that are going on right now. Now, I know when I stop sharing it, it's going to populate, so I know that. But I'm going to humor it just for a second because I need it to populate because I need to see something. All right, so we're looking at the debt clock from this perspective. I'm going to go ahead and close this, close this, close this, and close this. And we're going to refresh the debt clock. And let's just try this from a different perspective. Because, see, if you haven't seen this U.S. debt clock, let's try it this way. Okay, we got a U.S. debt clock here. National debt clock right now. Let's go to the United States debt clock from this perspective. And we'll try to just see if we can see the United States debt clock from a certain perspective. And all right, that's the debtclock.com, but there was one that I wanted to see where you can actually see the numbers oscillating. Let's try it this way. I'm gonna look at it from this perspective. Just bear with me. Okay, we have it being populated in this capacity. Now let's go back. See if we'll get a reading from a different browser. Because if I don't see it in this browser, then I'm going to elect to go to a different browser to see if that'll help me out. Let's see what we got here. Okay, here we go. All right. We got numbers populating here, which is what I want to see. So let's now share the screen so you'll see what I'm talking about. Share the screen. Go here. Go here. Go here. Go here. And I'll share it right here. Now we're sharing it. Now you're watching the debt clock as it oscillates, okay? Now, staring at this debt clock and it's oscillating. To check out the going concern, I want you to go to the state debt clock, So I'm in Florida, so I'm going to toggle on Florida. Okay. We're letting it do its thing. Hopefully we'll get something populating here in a minute. Maybe we will, maybe we won't. Maybe it's, I think it's getting camera shy on us again. Doesn't want to populate. I think this whole sharing capacity doesn't agree with the oscillating proponent. All right, so let's start share again. Stop share. Then we'll go back and refresh. Refresh it again. All right, well, let me try a different browser now. Because I think maybe it's the browser. Let me see something. Let's see if changing the browser will let us see what I'm trying to show you. Just bear with me, it's coming. All right, let's see here. We had something that just populated here. Okay, so let's try the U.S. debt clock from this perspective. U.S. debt clock. Let's try it from this perspective. Let's see if we get some synergy here. US debt clock. Yeah, let's try this and see what we get. I'm just curious. I mean, because if it doesn't, then I can always do something a little different. Okay. And we'll go to this debt clock here. Go to Florida. Right here. Mm-hmm. We're waiting for it to populate. Waiting for it to populate. There we go. Try it. All right. So now, let me share my screen again. All right. All right. You're at the debt clock now. This is the Florida debt clock. Pay attention because if you listen long enough, you definitely will learn something. All right. You see right here where it says interstate revenue, hundreds, thousands, millions, billions. Hundreds, thousands, millions, billions. So in-state revenue is 162 billion. The state is taking in 162 billion. Yet the state is spending, you see it, 239 billion. Okay. State is taking in 162 billion. The state is spending 239 billion. So when you look at the territory and state that your organization, group, trust, fiduciary responsibility, wherever it is in the jurisdiction, and you're standing in a territory where the state or territory is taking in $1, but it's spending $2, you have to now adjust your books to be in line with what's happening around you. Now, I want you to think about it. Can you, in your everyday comprehension of how accounting works, spend more money than what you bring on your job? If your job pays you $1,000, can you spend $3,000? Now, a lot of people are scratching their head like, Bazell, I'm confused. Don't be, because this is like a radar. This is telling you the reason why the state gets to spend is because they didn't make enough. So they gotta spend 239,000 because they only are taking in 162. Their accounting is working in such a capacity where they're able to recoup every dollar that they issue. That means if they give it to someone, they're able to actually get another credit and or debit. See, in accounting, whatever you do on one side of the ledger, there has to be an equal and opposite on the other. This is the example of what we call going concern. So when your accounting isn't matching up with what the state is doing and what the government is doing, then you can take advantage of these accounting concepts and or conventions. Now, with that, I'm going to go ahead and stop the share. I think one person's got their hand raised, so I'm going to see if I can cue them in and maybe get a question or two answered. If you guys have any other questions, comments, or concerns, please feel free to press 9-4 on your keypad so that I may, cue you in and see if we can get some of these questions answered. All right, Trey, if you can hear me. Can you hear me? I think I unmuted him. Yeah, I think I did. At least that's... All right, let's try this again. Yeah, Trey, your hand is raised. You got a question? Can you hear me, Trey? I got him unmuted. I can't hear him. Try this one more time. All right. So without further ado, since I can't get him in, we'll just keep moving. We'll keep it moving. I'll come back and I'll free everybody up to ask any other questions, comments, or concerns at this point. These concepts are very important. What I just showed you was the going concern concept from a real life perspective using the debt clock. This accounting manual, in my opinion, is very important because it puts everything in its right perspective with real world examples. The first 20 some odd pages, in my opinion, are crucial. So please read this information, numerous times, and then that way you kind of get a fundamental aspect of how things go. I always tell students you're going to need an accounting concept, so we'll give you one. I want you to write this concept down. I want you to use the accounting concept. Assets equal equity plus liabilities. So it'll be assets equal E for equity plus L for liabilities. So it'll be A equals E plus L. Assets equal equity plus liabilities. I want you to wrap your brain around that concept. That's not the only accounting concept and or principle or equation, but I want you to have a foundation. So assets equal owner's equity added to liabilities. So if you classify an expense, credit and or debit as a liability, and you add that credit and or debit to the owner's equity, that combined total sum makes up your assets. Are we clear? Is everybody clear on that? If you're clear, then at least, let me know that you're at least comprehending what I'm saying by typing into the chat that you understand. If you don't understand, you got questions, go to the chat, because I'm going to the chat right now. I may have somebody that might have asked a question or two. All right, so so I see he's got, so the entity is to identify the entity, sole prop, and the trust, correct. Is Aris using accounting concepts, conventions, or both? Aris is going to not tell you what accounting concept to use. Aris is going to say, based upon the data that you entered, these are the forms that you need to fill out. Now, if this is not the desired effect, then you are able to make that adjustment. I can critique it to do that. I just don't want to, because I don't want to get into the business of doing accounting when I'm teaching you accounting. I don't want to do your accounting that way. I can, but, hey, I can give you my retainer and my fee schedule. I'll just say it that way. I prefer to allow the software to give you the forms necessary for you to use in that regard. Let's see what else. I got another question that was in here. Well, that's the only other question that I see, those two right there. Guys, if you got any other questions, comments, or concerns, and if you haven't already pressed 9 on your keypad for me to bring you on, but you want to ask a question, feel free to post a question or two inside the chat. For everyone else, I'm asking, do you understand what we covered up until this point? And I want you to put your answer, yeah, I understand, I know I don't understand, inside of the chat at this time. You can go inside of the chat here inside of this particular course that we're going through, and there should be a tab where you can actually type in your responses. I'll give you a few minutes to do that. Yeah, I'm double checking to see if we got anybody that want to ask a question that hadn't had a chance to. All right. Well, with that being said, keep listening, because if you listen long enough, you definitely will learn something.
This initiative has raised concerns about its potential implications on user privacy and software freedom. The Web Integrity API, a solution to ad tracking. Google's endeavor with the Web Integrity API reflects its determination to regain control over ad tracking and cross-domain user tracking. The API seeks to provide Google with a more secure and reliable mechanism to authenticate users, curb cheating in games, and ensure content integrity. While this initiative could enhance the trustworthiness of online interactions, it also raises questions about the extent of control Google would exert over user experiences. Privacy versus functionality, Apple's developer policy. Apple, on the other hand, has introduced a policy shift that mandates developers to disclose and explain their usage of specific APIs, with a focus on privacy and user data protection. This change has sparked debates within the developer community regarding the balance between safeguarding user privacy and maintaining app functionality. The scrutiny of APIs, especially the user defaults/API, has prompted developers to assess the implications of these policy changes on their app's development process and user experience. Large language models and the FOSS community. As the software industry evolves, large language models have emerged as powerful tools that both aid and concern the open source community. Some argue that these models are stripping the value of open source contributions by facilitating code generation without proper attribution. However, it's important to recognize that these models are iterative and require human input for training, making them more of a useful tool than a direct threat to the FOSS ecosystem. A reality check, balancing concerns with realities. While concerns about platform control, privacy, and the impact of large language models are valid, it's essential to maintain a balanced perspective. The tech industry is complex, comprising a range of stakeholders and interests. Striking the right balance between safeguarding privacy, encouraging innovation, and fostering software freedom remains a multifaceted challenge that requires careful consideration.
Understanding standardized debt applications and automated underwriting. Introduction. In the world of finance, standardized debt applications play a crucial role in capturing and conveying vital financial data. These applications serve as the foundation for various types of loans and credit evaluations, such as mortgage applications, personal loan applications, and credit card applications. This article delves into the significance of standardized debt applications and how they are used in conjunction with automated underwriting software. The importance of standardized debt applications. Standardized debt applications, regardless of the specific type, e.g., 1003, UCC, driver's license, or marriage certificate applications, follow a basic format. This format includes essential information such as name, address, and 9-digit identifier, EIN or social security number. Additionally, it captures details about assets, bank accounts, and insurances. The primary purpose of a standardized debt application is to register the data it collects into a database. This database is then used as the basis for automated underwriting software, which streamlines the loan approval process by evaluating the applicant's financial situation and creditworthiness. Automated underwriting software and data parameters. When an applicant's data is entered into the automated underwriting software, the system processes the information and generates a value parameter. This value can be categorized as either pre-ledgered, debit, or ledgered, credit, depending on the user's or implementer's intention. To gain approval through the automated underwriting process, the standardized debt application must adhere to specific formatting rules. The required information includes name, address, EIN or social security number, and details about assets, bank accounts, and insurances. This consistent structure ensures that the software can effectively assess the applicant's financial situation. Standardization across different applications. Interestingly, if we compare various standardized debt applications, such as the 1003 personal loan application and car financing application, we notice striking similarities in their content and structure. The headings may differ and the applications may be branded differently, but the fundamental information remains the same. This similarity makes sense since all these applications seek to obtain pertinent financial information about the applicant. Whether it's a mortgage or a personal loan, the questions and required data are generally consistent across applications. Understanding the role of credit reporting agencies. The data collected through standardized debt applications is not only used for internal processing but also shared with credit reporting agencies like Equifax, TransUnion, and Experian. These agencies play a dual role. 1. Data population *. Credit reporting agencies collect and populate the data from standardized debt applications into their databases. 2. Report generation *. Using this data, they generate credit reports for individuals, providing lenders with valuable information about an applicant's credit history and risk profile. The shift to fully automated underwriting. Previously, underwriting software like Calyx was instrumental in aiding loan officers in the decision-making process. It would analyze the data and provide potential lenders for the applicant based on their financial situation. However, with advancements in technology and the internet, the underwriting process has evolved. Today, fully automated underwriting systems handle the entire process. When applicants fill out the standardized debt application, it directly feeds into the software, which then evaluates their eligibility and creditworthiness. Debt-to-income ratio and beating the algorithm. One critical aspect evaluated by the underwriting software is the applicant's debt-to-income (DTI) ratio. To be approved for additional credit, applicants typically need to keep their DTI below a certain threshold, often around 10% of disposable income. To ensure approval, applicants can utilize specific strategies to manage their accounting and financial situation, such as leveraging certain assets to maintain their DTI at the desired level. By understanding and manipulating these algorithms, applicants can increase their chances of approval for loans and credit. Conclusion. In conclusion, standardized debt applications and automated underwriting have revolutionized the loan approval process. These applications collect crucial financial data, which is then processed by advanced software to evaluate an applicant's creditworthiness. By adhering to specific formatting rules and leveraging assets effectively, applicants can improve their chances of approval in the automated underwriting system. Understanding these processes empowers individuals to make informed financial decisions and navigate the credit landscape more effectively. Leveraging the algorithm, understanding financial transactions and automated systems. Introduction. In the ever-evolving landscape of finance and technology, understanding the algorithm behind automated underwriting and financial transactions becomes crucial. This article delves into the concept of leveraging the algorithm and how standardized debt applications play a vital role in the process. The algorithm and debt-to-income ratio. The algorithm used in automated underwriting determines an applicant's creditworthiness by assessing their debt-to-income (DTI) ratio. To keep the DTI within the acceptable range, individuals must ensure that only a specific percentage of their disposable income goes towards debt payments. Some key points to consider are: debt-to-income ratio. Ideally, individuals should aim for a DTI of 10% or lower to optimize their chances of approval for additional credit. Bringing a surety. To maintain the desired DTI ratio, individuals can bring a surety, covering 10% of their disposable income, whenever they take on new debt. Utilizing assets to control DTI. Controlling the DTI ratio is crucial, and it can be achieved by leveraging assets effectively. Here's how assets can be utilized to manage the DTI ratio. Transportation industry example. Consider the transportation industry, where acquiring a tractor-trailer worth $100,000 with $1 million of insurance allows one to claim both the truck's value and the insurance as good debt. This enables leveraging these assets to support loan applications. Manufacturing and depreciation. Manufacturing businesses can buy million-dollar equipment and leverage it in their projects. Additionally, such assets can be depreciated over time, offering tax benefits. Real estate acquisitions. In real estate, understanding the algorithm and valuations is essential for optimizing investments. Properly classifying assets and transactions in accounting can help navigate the algorithm's influence. Implementing personal accounting strategies. To make the most of the algorithm and automated systems, individuals should consider implementing personal accounting strategies. Three-way reconciliation. Implementing three-way reconciliation between private books, public books, and external agencies ensures consistency and accuracy in transactions. Direct object and fulfillment. Every transaction has a direct object, and individuals have the liberty to fulfill it as they see fit, as long as they adhere to accounting principles. Tandem accounting. Consider tandem accounting, where different entities within a financial ecosystem work together to maximize opportunities and manage obligations effectively. Understanding the impact of the algorithm. The algorithm's impact on financial decisions cannot be underestimated. As the pendulum of financial regulation swings, individuals must understand the algorithm's impact and utilize it to their advantage. Redefining transactions, correcting the records and classifying transactions appropriately can lead to favorable outcomes, especially when the algorithm swings in a different direction. Individual empowerment. Understanding the algorithm empowers individuals to navigate financial systems more effectively, make informed decisions, and optimize financial opportunities. Conclusion. In conclusion, leveraging the algorithm is the key to success in the modern financial landscape. By understanding how standardized debt applications, automated underwriting, and accounting strategies work together, individuals can control their debt-to-income ratio and optimize their financial positions. Embracing the algorithm empowers individuals to make the most of financial opportunities and achieve their financial goals with confidence. Understanding the power of AI in financial transactions. Introduction. The use of artificial intelligence, AI, and algorithms in financial transactions has revolutionized the industry, allowing for greater efficiency and accuracy. This article delves into the impact of AI on financial systems and how it can be leveraged to optimize transactions. The role of AI in securitization audits. When conducting securitization audits, compliance officers can use AI to pull out and categorize assets effectively. Understanding asset classes and their conversions is crucial in this process. Key points to consider are: M3 assets. The creation of M3 assets enables access to M2 and M1 assets, allowing for a comprehensive understanding of the transaction. Securitization audit. AI can assist compliance officers in conducting efficient and accurate securitization audits, creating a clear picture of the assets involved. Understanding commerce and disclosure. Navigating financial systems requires understanding the importance of disclosure and the right legal vehicles. Key points to consider are: trusts and disclosure. Utilizing trusts can provide the benefit of non-disclosure, making it essential to choose the right legal entity for transactions. Portable land transactions. Timing is crucial when reporting portable land transactions. Waiting until after the transaction is complete can be advantageous, avoiding potential scrutiny. Leveraging AI and accounting strategies. AI can be harnessed to optimize financial opportunities and ensure compliance. Key points to consider are: three-way reconciliation. Implementing three-way reconciliation between private books, public books, and external agencies ensures accuracy and consistency in transactions. Tandem accounting. Utilizing tandem accounting allows entities to work together effectively, maximizing opportunities while adhering to accounting conventions. AI-prompted transactions. AI platforms, like Banking in the Box, can be prompted to generate real-world scenarios and conveyance models for various transactions. The impact of AI on financial standards. AI has influenced financial standards, leading to changes in accounting practices. Key points to consider are: new financial rules. In response to financial instability, new rules such as CECL have been introduced, providing alternative approaches to reporting and credit. Advantages of AI. Understanding and utilizing AI's capabilities empowers individuals to make informed decisions, optimize financial opportunities, and achieve their goals. Conclusion. AI has become an invaluable tool in the financial industry, transforming the way transactions are conducted and financial data is analyzed. By harnessing the power of AI, individuals and organizations can navigate financial systems with greater efficiency and accuracy, leading to improved decision-making and overall financial success. Unleashing the power of AI in financial transactions. Introduction. The emergence of artificial intelligence, AI, and advanced language models like GPT 3.5 and GPT 4.0 has revolutionized the financial industry, offering new possibilities in transactions and data analysis. In this article, we will explore the potential of AI in financial systems and how it can be harnessed to optimize transactions. Creating AI-prompted datasets. AI can be trained and prompted to think in a specific manner, aligning with the thought patterns of compliance officers and other financial professionals. Key points to consider are: AI construct. By feeding data points and prompts to AI constructs, you can influence its thought patterns and create an AI that aligns with your thinking. Building private libraries. Utilizing GPT-for-all, you can build your private library of data sets that cater to your specific needs and prompt the AI to respond accordingly. Leveraging AI in compliance and audits. AI can significantly impact compliance and audits, improving accuracy and efficiency in the process. Key points to consider are: compliance officers' advantage. With access to private trust cases and other relevant data points, compliance officers can stay ahead of the curve and make informed decisions. Securitization audits. AI can be instrumental in conducting securitization audits, allowing for the categorization and understanding of various asset classes. Understanding the role of APIs. APIs, application programming interfaces, play a crucial role in interacting with financial institutions and accessing their data. Key points to consider are: API tethering. Developing APIs for your datasets allows you to connect with financial institutions directly, enabling seamless interactions. Accessing banking APIs. Financial institutions provide access to their banking APIs through their websites, and diligent exploration can lead to valuable connections. Maximizing opportunities with AI. AI can be a powerful tool in optimizing financial opportunities and making well-informed decisions. Key points to consider are: AI-driven decision-making. ChatGPT and QuickBooks integration can lead to intelligent decision-making in financial transactions. Developing AI functions. Creating functions for AI to interact with data and APIs can enhance its capabilities and provide tailored solutions. AI is a future game-changer. The widespread adoption of AI and advanced language models is set to transform the financial landscape in the future. Key points to consider are: corporations and AI. Financial institutions are likely to monetize their datasets and offer access to APIs for a fee, revolutionizing the industry. AI's asymmetric information. Understanding the asymmetric nature of AI and its impact on decision-making is essential for developers and financial professionals. Conclusion: AI-powered financial systems offer unprecedented opportunities for efficiency, accuracy, and optimization. By understanding the potential of AI and advanced language models like GPT 3.5 and GPT 4.0, financial professionals can harness this technology to make data-driven decisions and stay ahead in an ever-evolving industry. Embracing the power of AI will undoubtedly be a game-changer for the future of finance. Understanding AI-powered financial transactions. Introduction. The advent of artificial intelligence, AI, has transformed the financial industry, offering new opportunities for optimization and efficiency in transactions. In this article, we will delve into the use of AI in accounting, reconciliation, and funding, exploring its potential to revolutionize financial processes. The power of ledgered accounting. ABC Trust/Estate Accounting. Utilizing a unique accrual method, ABC Trust manages its accounting without traditional T accounts, instead using a combination of plus and minus signs. Ledger and notarization. By notarizing and witnessing accounting transactions, ABC Trust ensures that its ledgers are accurate and legally binding, providing an indisputable record of its financial activities. Leveraging AI in reconciliation and transactions. AI in transaction reconciliation. AI can play a significant role in reconciling complex financial transactions, ensuring accuracy and integrity in the process. Transaction funding. By using AI to analyze and substantiate transactions, funding can be secured efficiently, regardless of the medium of exchange. Automated underwriting software. Major corporations and financial institutions rely on automated underwriting software to qualify, sequence, and convey transaction values. Addressing taxation and liabilities. Tax credits and liabilities. Understanding tax implications and liabilities is crucial when issuing transactions. Proper accounting and reconciliation ensure compliance with tax regulations. Private versus public side. Distinguishing between private and public accounting and providing clear notice to all parties involved in a transaction can mitigate potential issues. The role of APIs and financial institutions. API integration. APIs act as bridges between datasets and financial institutions, allowing seamless interaction and access to essential information. Monetizing datasets. Financial institutions may monetize their datasets, offering access to APIs for a fee, thereby revolutionizing the industry. AI is a future game changer. Asymmetric information. Recognizing the asymmetric nature of AI and its impact on decision-making is crucial for developers and financial professionals. AI-driven decision-making. The integration of AI and advanced language models offers unprecedented opportunities for data-driven decision-making in the financial sector. Conclusion. AI-powered financial transactions have opened up new possibilities for efficiency and accuracy in the financial industry. Understanding the potential of AI, leveraging APIs, and conducting proper accounting and reconciliation can empower financial professionals to make informed decisions and stay ahead in this ever-evolving landscape. Embracing AI's potential will undoubtedly be a game changer for the future of finance.
All right, all right. Now I'm gonna hit you with a little somewhat of a DTC insight, which should help a lot of people, especially your new guys who are definitely getting their feet wet with dealing with the DTC, DTCC. So keep in mind, there are certain bill of exchanges that you're going to use that's going to be hedged to the court register investment system. We're going to say those that make deposits are going to use the DTC side of the equation. Those that are going to be making withdrawals are going to be using the DTCC side. Again, new people, just write and take notes. You will get access to this class, so at least listen to this. Take notes, pause it, stop it, get this information to your frontal lobe, because if you keep listening long enough, you definitely will learn something. The DTC side is where you will make your deposits. The DTCC is where you will make your withdrawals. Now, let me show you something pertaining to the DTCC from an internal standpoint. All right. I'm going to start with this document right here. Good old implementation guide. And for those of you that have already registered inside of ERIS, if you did it correctly, you actually got access to this document upon your ERIS registration. So for those of you that say, well, Mr. Bay, I still don't have my DTCC implementation guide, I'm giving you the option, because we do charge for this guide. If you have something that needs to be registered with the DTCC or DTC and you haven't already registered with ERIS, then when you complete that registration, you're going to receive an implementation guide. If you don't have anything to upload and you still need a guide, then just make that request known and I'll give you a link where you can pay for it and receive it. Here's the implementation guide. And I want you to understand that this particular guide is based on Accord Life and Annuity standards. Yes, everything that's being withdrawn out of the construct, the DTCC, has a proponent of insurance that's attached to it. Now, as you look through this table of content, we talk about the process overview, the replacement process participation assumptions, the replacement process service requirements, the basic message level choreography, the general DTCC's processing rules. That's on page 9. Let's visit that for a second. Something I want to show you. Page 9. This should be page, is this page 9? Page 10, page 9. General DTCC's processing rules. For unified documentation maintenance and less duplication, all process rules include references to pending case study. TX Life 1125 rules will appear on this document and are not the pending case status implementation guide. Data is case sensitive. When alphanumerical characters are used with data values, use proper case, upper and lower, to match the previously stored values. Gives you the actual schematic, the schema version, the replacement transactions. They're telling you how it's going to be placed into the system. Then they're going to give you the message time frame process. DTC message time frame process will process messages when received, not as batch processes. The messages will be validated and delivered to end the destination or rejected back to the originator for correction. In other words, they're going to do it in real time, and they deal with CSV format. So this is getting a little techie for a lot of you guys, but let's just say it's a fancy way of saying they're passing data through data cells in spreadsheets in real time, and they have a messaging system. Keep in mind, if you listen long enough, you will learn something. Participant acceptance to send and receive messages. Carriers who elect to participate in the replacement process will be eligible to process all messages. That's all those things that show up in the TX Life 127, 128. Let me break this down for you new people. When you go to the DTC's website today, they allow you to go directly onto the interface and take a full data dump of all records inside of the DTC and DTCC. All LEIs. But if you don't understand the format upon which it's formatted, well, that's just data that you have no idea how to decipher. I'm showing you this implementation guide from this perspective for a reason. Because of this document right here, which, bear with me while I bring it up. This document here should help shed some further light on a subject that very few, in my opinion, choose to really go into certain detail. And again, because you guys are notaries and training and compliance officers, this is the only reason why I'm covering this. We're not allowed to share this type of proprietary information with civilians. But again, if you're going to be working in the space, you got to know where all the bones are buried. So, without further ado, let's take a look at a document, an actual PowerPoint from the DTCC that deals with global legal identifiers when they initiated this. Okay. The LEI public policy objective is to strengthen systematic risk capabilities, regulators to analyze positions and transactions of firms they oversee on a global integrated basis. So again, the purpose of the LEI is to strengthen systematic risk capabilities and regulators to analyze positions and transactions of firms they oversee on a global integrated basis. Let me explain this a different way. Have you ever heard of an EIN number? Probably. Have you guys have heard of a Dun and Bradstreet number? Probably have. Now, prior to you coming into this class, how many of you have ever heard of an LEI? What about a GLEI? So this initiative went into effect back in 2013. So keep listening, because if you listen long enough, you'll learn something. New acronyms, like any good project. You got acronyms like GLEIS, which is the Global LEI System. You got ROC, which is Regulatory Oversight Committee. You got GLEIF, which is the Global LEI Foundation. You got COUs, which are Central Operating Units. You got LOUs, which are Local Operating Units. Then you have the standard, ISO 17442. That's the standard. Then you have CC, which is the CFTC Interim Compliance Identifier. Then you have GEI, the General Entity Identifier in Europe. LEIs must be standardized globally. The LEI is a single, unique 20-character alphanumeric code that is assigned to all entities that are counterparties in financial transactions and listed in an open database available to all as a public good. I repeat, available to all as a public good. The FSB and ROC has endorsed and adopted ISO standard 17442. This is what you would look like in the system. That'll be your LEI. It'll be attached to a legal name, address, country, registry number, entity status, legal form, dates, etc. Global Regulatory Committee LEI Initiative. FSB delivered initial recommendations to G20 in June 2012. FSB transitions its responsibilities to the Regulatory Oversight Committee July 2013. The ROC adopted FSB principles. And again, just kind of giving you a little bit of background about LEIs and GLEIs. Now, here's something as compliance officers that you are allowed to do once you have completed your training and you're ready to participate in the various different opportunities that are there. 80%, a little over 89, almost 95% of the general population has no idea that if they have a EIN number, that EIN number is associated with some type of counterparty, LEI and GLEI. Now, let's say for laughs and giggles, this client comes across your desk and they're trying to get something funded, and they've gone through all of the civil, the gymnastics of not being able to get money and this, that, and the other. And they got solid ARs, which are accounts receivables, and solid APs. Well, if they have solid ARs and APs, you can utilize as a compliance officer arbitration, and we can utilize what we call automated underwriting software, and we can attach all these missing pieces to a fully functioning LEI and GLEI, which makes them bankable and marketable, which puts them in the capacity to handle M3 conveyances, meaning that they'll be able to deal with money at the most protected access point. Now, I know I went a little over a lot of folks' head in that explanation, but again, if you listen to this about 7 times, I think it'll start to make sense to you. I'm feeling a little ahead of myself, which means whenever I feel ahead of myself, I usually stop because I don't want to convolute. I don't want to confuse. I'm looking for feedback. I am going to open up the class for Q&A. Now, which means I'm expecting at this point, out of everything that we've talked about up until this point, for you to ask questions. Either post it inside of the chat or simply press 9-4 on your keypad. Well, I will bring you in for you to ask questions. Now, again, I'm not a mind reader. I'm only assuming based upon your response or lack of response that either you getting this or you're not getting this. And again, new people, don't panic if this is all new to you and you don't want to say something wrong. Then I'll give you a few minutes to gather your questions, and if we don't have any questions, then I will allow this class to adjourn, populate inside of the Bitrix, then you can go back and listen to it at your leisure, and hopefully if you listen to it long enough, you'll learn something. But I want you to understand that dealing with funding through the DTC and DTCC is actually being done whether you participate in it or not. It's being done despite your lack of participation. This is one of the main clogs in the wheel of commerce. It's a system. I'm now looking for any comments, questions, or concerns of anything we've talked about up until this point. Any questions?
Yeah, I have a quick question.
Go ahead. Go
So
ahead.
you're saying that when you put your can you hear me?
I can hear you loud and clear.
Okay, yeah, my phone has been acting crazy. So when you're saying put our information into Eris, and then Eris is going to populate the missing information based on what you're showing us with this DTC sample.
This is one part of it. Like most people who have transactions that look to be funded. And this again, if you have already gone through KYC and all that, then you're already in the system. I'm talking to individuals that are coming to me. I had about 40 people today, all new people from all over the space. They're not even in Bitrix yet, that need things put into a certain proponent. So what we decided to do is we opened up that registration to get what you're talking about into a quantified format where I can at least talk to you tangibly about said situation prior to arbitration. So when you go and register and you put in the subject matter line what this subject is about, that's going to predicate the accounting, forms, this, that, and the other. If you just put I need help, then you already know what kind of response you're going to get. Probably none. So the system is prompt to convert what you're saying into a mathematical formula that works with the security settlement system. It'll do everything you thought it would do, and it'll do nothing if you don't give it the proper input and prompt.
So if we need to draw documents or edit something, how do we do that?
You have to edit that before you intake, because once it goes in, the algorithm takes over from that standpoint.
Measure twice, cut once. Okay.
Any other questions?
No, everything else I posted in the chat.
Gotcha. Beautiful, beautiful. All right. Is there anyone else that has any questions, comments, or concerns? Please press 9-4 on your keypad or post your question inside of the chat. Okay. All right. I think I got a question from Lou. It says, I'm just taking it all in right now. Okay, good deal, good deal. All right. Any questions? Like they say in the auction, going once, going twice. All right. Well, look, I appreciate everybody's time and energy. Those of you that are in our Bitrix space. Oh, I do got a question. Okay, so I was just finna say, speak now, if ever hold your peace. Let's see here. Let's see if I can bring them on here. All right. Brother Antoine, talk to me.
Yes, how you doing, bro?
I'm hanging. Big bro, what's good with you?
Could you repeat that again about when we enter the information in the Eris and about the subject line?
When you put in the subject line the details of the subject that's at hand, it wants to know what type of article of security interest do you have and what do you foresee happening? What do you want to happen? What do you need? What are you desiring? That's laying way to an AI that's going to think about, I'm telling you what it is. When you put in the subject line what you're asking, you're like asking ChatGPT. Because that's what you're doing. So if you need specifics, if you need, that's what the subject matter line is for.
And the uploaded documentation.
Right. The support was being so they have a working example.
Okay.
All right. Any other questions?
No, I don't think so.
Okay. All right.
So can I ask a quick question about this? As far as the Eris,
Hmm.
ARIS goes through the securitization audit as well as like legal jacks, or that's separate.
Basically, it's a different AI. I have different AIs for different functions. So Eris' sole purpose is to serve
Okay.
as the arbitration registry investment system. So when you make inquiries into that portal, it is for the sole purpose of registering that inquiry for monetization purposes. The
And
underwriting
so, what is
software is
the
taking right. It's without getting too technical. Basically, you got one system where you're specifically talking about something from an arbitration standpoint, or you're requesting arbitration. So that's where the securitization audit comes into play. During that audit, we'll fast forward. Some of you guys are going to be using Ares to monetize stuff you already got and further monetize stuff that you're getting. New people are going to use Ares to go from A to Z based on their data sets and prompts.
Okay, I can follow that. So what I was trying to understand is, like, with this securitization audit, is there an accounting principle or method that's used, like how you were teaching us earlier?
I'm gonna give
There's
you the
concepts
safest
and
thing in the room.
conventions.
I did not put a specific principle in because it's different strokes for different folks.
Gotcha.
So it's going to provide you based upon what the task at hand, the forms you need. If those forms that you need create a liability for you, then you have the ability to reprompt the system. I don't want to get into telling you how to move. If so, then I will give you my fee schedule, and then that's how it'll go. And the reason why at this genre I don't want to participate on that level is because it's a lot of restraints. Usually, when I'm asked to do accounting for a firm, your accounting's got to be immaculate. I can't be looking for stuff, and if it's unclear, I'm not going to approve the transaction. Because if you can't explain it to me in a one-liner, then it's too convoluted for me. So what I
So
did with
it needs
some,
to be expressed in it needs to be
right,
expressed in the footnote.
right. So I see a lot of individuals, they're not used to doing footnotes. They're just used to say, well, here's my bank statement. Can I get funding? And that's not going. So to make it easier for new people, I just simply allow it to take what you give it and provide the forms necessary. Because there's not no right or wrong. I have principles. It's certain things that I am not going to, like I can't do anything that's going to, violate the integrity of my estate. I can't go outside of my trust res. So if it's doing those two things, that doesn't mean it won't get done. I just may point you to someone else who's willing to do that. Did that kind of answer your question? Hopefully that answered your question. Any other questions, comments, or concerns before we adjourn? If you have them, please press 9-4 on the keypad. We're going to say going once. I'm going to say going twice. With that being said, look, I appreciate everybody's time and energy. If you're already inside the big space, please feel free to message me. For those of you new students who don't already have your accounting manual, please make it known inside the big space so I can get that to you. And with that, I'm going to say peace and love, family. Peace and love.